Hi, welcome to the Power of Biz YouTube channel. My name's Tim, and I am here to talk to you about all things business, buying businesses, running businesses, buying real estate, running real estate. I want you to succeed in whatever it is on your path to financial independence, financial freedom. Today, we're going to jump into the topic of cash flow. What is cash flow? This is a term, if you've been looking into buying a business or buying real estate, you hear this term cash flow thrown around a lot. On the surface, it sounds pretty easy to understand. Another term that you may see or hear, especially in buying businesses, is owner's discretionary income. So these two terms are related. They're not necessarily exactly the same, although different brokers may interpret them the same. So it's important to kind of know the nuances and differences of each, but especially cash flow. So on the surface, like I said, cash flow is very basic. You have money coming in minus the money going out equals cash flow, money left over. So it gets a little bit more nitty-gritty than that though. So for a business, let's just take a business with an example that is doing $1 million a year of revenue. That's $1 million of sales revenue, whether it's retail or professional services, whatever it is. Their customers are paying them $1 million a year. Now, the first thing we need to deduct is the cost of the products that they're selling. So in a retail example, let's just say that the products that they sold, the business had to pay $500,000 for. So take that $1 million, you subtract the $500,000, you're left with $500,000. But the business has other expenses. So in accounting, for small businesses, for businesses in general, they break up the cost of goods versus the rest of the expenses on the profit and loss statement. Those other expenses, advertising, marketing, staff, labor, rent or utilities, office supplies, all those other things. So let's say that adds up to another $250,000. So now we're at a total of $1 million minus 500 minus another 250. So the net profit of the business is $250,000. Not bad. It's great profit for the business owner. But if that business owner has debt payments, those payments didn't necessarily show up in the profit and loss statement. A lot of times the interest portion will, but for the sake of this argument, we're just going to say that all that debt payment comes out after the net profit. So if that business owner has $100,000 a year in debt payments, loans that they use to either buy the business or buy equipment or vehicles, whatever it is, those payments come out after the net profit is calculated. So we're at $250,000. Now we subtract another $100,000. So at the end of the day, the actual cash flow of the business is $150,000 because of that debt payment portion that came out after net profits. To make it a little bit more complex, there's a particular expense. There are some expense items that show up on the profit and loss statement that are not actually cash going out of the business, notably depreciation and amortization. So these are expenses that may have came out earlier for a big purchase that gets spread out over years of time. So in this particular case, let's just say that the owner was showing $25,000 expense for depreciation. So we would take that $150,000 and we'd add back in that $25,000 because that cash is still sitting in the bank because it didn't actually leave like the utility payments and the rent payments and the payroll payments. It's just sat there because it's a loss on paper, but it's not actual cash leaving the business. So all said and done, that owner had $175,000 of cash flow for the year. However, let's add another little complexity to this example. Let's say that owner decided that he needed a new piece of equipment in that particular year. And that piece of equipment cost $100,000. Now for general accounting rules, and for the IRS specifically, that $100,000 purchase of a piece of equipment does not get to count as an expense in year one. That expense will get depreciated or spread out over a certain number of years depending on what type of classification that equipment is in. So let's just say that piece of equipment gets depreciated over 5 years, which would be $20,000 a year for the next 5 years of depreciation. In the future years, that depreciation will get added back in, like we just showed you with that $25,000. However, in this year, that $175,000 of cash flow actually just dropped to $75,000 of cash flow because that $100,000 had to go out to buy that new piece of equipment. So a lot of variables go into the cash flow. If you're familiar with real estate, or you're a real estate investor, you might kind of equate that to somebody that's making $3,000 a year in actual cash flow after all their expenses and debt payments, and they feel great about themselves. They're going to get $3,000 at the end of the year in their pocket of cash flow, but then the furnace breaks and you need to go replace it, and that costs $3,000. Your actual real cash flow at the end of the year becomes zero because you had to spend that $3,000 that you thought you were going to make. So that's cash flow in a kind of a brief overview. The seller's discretionary income, or just seller's discretionary earnings, is a little trick, for lack of better words. It's not really a trick, but it's something where a broker or a seller of a business will start adding back into the cash flow all of the specific expenses that the owner thinks are only being expended because they benefit the owner personally. So one of the easiest examples of this is the owner's salary. Let's just say that the owner is running a small retail store and they are the general manager of that store. They are actually running the store, but they're paying themselves a salary of $150,000. Now, the seller might say, well, $150,000 is just going to me, so that's part of the seller's discretionary earnings. In reality, you could probably hire, let's just say you can hire a store manager for $75,000. The seller's discretionary earnings is that over and above what you're going to need to hire a manager to replace that seller when they leave. So the discretionary earnings are that $75,000 extra that the owner is paying themselves. That, again, you're going to need to hire a manager, whether it's yourself, and you're paying yourself $75,000 a year, or whether you hire somebody else. That is just part of the operations of the business. So finding a fair salary to replace the owner is an important step in this. In some cases, the owner might not be paying themselves enough, which then you would need to deduct from the seller's discretionary earnings if they're paying themselves extra in other areas. So the other things then that get added to the seller discretionary earnings is if the owner's paying for a car for themselves that is not necessary to running the business. If the owner has their whole family on the cell phone plan that is through the business, that can get added back on. Random office supplies, other types of expenses. Maybe the owner's been going on trips that are business related but not really necessary for the running of the business. Those can get added back in as seller discretionary earnings. Again, you need to evaluate each one of those expenses carefully. You can't just take the owner's word for it that, oh, all of those janitorial supplies are actually going to my house, so therefore we need to add another $1,000 on. Or that trip is really not necessary. I just do it because I love going to Vegas every year for that conference. You might decide that, well, actually, I do need to be at that conference every year if I want to maintain business relationships and things like that. So that is not a discretionary earnings. That is a actual expense of the business every year. Why does all this matter? Why is it so important that you're meticulously calculating cash flow and seller's discretionary earnings? Because that's usually how businesses are valued. Usually you're taking some type of multiple of the cash flow you can earn to decide what the business is worth. And so if you take that seller's discretionary earnings and you let the seller add, and say that they're taking out all of this expense, is not really business expense, but it's going to their house, them personally, and you overpaid because now you multiplied that number by 3 or 4 or 2, whatever that multiple is, you're going to realize in the first year or two that you actually don't have enough income coming in to run the business successfully and pay yourself a salary. So it's very important that you don't just take the seller's word for those types of things or the broker's word for them, but you carefully analyze it. One of the things that I kind of like to say to sellers is, if you were, one of the reasons that a lot of sellers do this, and nobody's perfect, there's a lot of business owners that do it, not faulting them for it, but one of the reasons that they like to do that is that they're using pre-tax dollars to pay for certain things, which gives them a little bit of a benefit personally. Therefore, they're paying less taxes. My kind of opposition to that, or pushback on that, is, well, you had all these years of paying a little bit less in taxes. Now you have to take a little bit less of a sale price because of the way that you operated. If you operate completely by the books and pay that little extra tax every year for 10, 20, 50, whatever years you go in the business, your books and your accounting will look so much cleaner that your net profit will be higher, your cash flow will be higher, your owner's discretionary income will legitimately be higher, and therefore you can ask for a higher sale price because it is verifiable that the business is running off of that particular set of income and those expenses. So, cash flow, money coming in minus money going out, whatever is left over. Seller's discretionary earnings or income adds back in some of those expenses that benefit the owner personally, that are not vital for the running of the operations of the business. Hope that clears up those couple definitions for you, makes them a little bit more clear. If you still have questions, please leave them in the comments below. If you liked this video, share it with a friend, hit the subscribe button. Really look forward to hearing you more, and look forward to seeing you in the future. Thanks for watching. Cheers.